Before we begin today's analysis, a brief word. If you're seeking thoughtful, disciplined perspectives on financial markets without the noise, I invite you to subscribe to this channel. We focus on rational strategy, risk awareness, and long-term preparation. No hype, no guarantees. Just careful analysis designed to help you think clearly about your financial decisions. Now, let's proceed to today's important topic. There's a threshold that many investors don't realize exists: 500 ounces of silver. It's not a magic number, it's not a guaranteed path to wealth, but it represents something meaningful in the current financial landscape, a position size that signals intentional preparation rather than casual speculation. Today, we're going to examine what this threshold means, why it matters now, and how you should think about it, whether you already hold physical silver or whether you're considering your first position. This discussion is for serious investors, people who understand that real wealth protection requires discipline, patience, and clear thinking during uncertain times. Let's begin with a fundamental question. Why does silver matter at this particular moment in financial history? We're living through an extraordinary period of monetary experimentation. Central banks worldwide have expanded their balance sheets to unprecedented levels. Government debt continues to accumulate at rates that would have been considered reckless just 2 decades ago. The purchasing power of major currencies faces persistent erosion. These aren't political statements. They're observable facts that carry financial implications. Silver sits at the intersection of multiple powerful forces. It's a monetary metal with thousands of years of history. It's an industrial commodity essential to modern technology. And it's a finite resource that cannot be printed or created through policy decisions. Understanding these converging pressures helps explain why a position of 500 ounces represents more than simple accumulation. It represents a calculated response to identifiable risks. But before we discuss position sizing, we need to establish the foundational principles that should guide your thinking. Silver occupies a unique position in financial markets. Unlike gold, which serves primarily as a monetary asset and store of value, silver serves 2 masters. Roughly half of all silver consumption comes from industrial applications: solar panels, electronics, medical devices, electric vehicles, and water purification systems. The other half relates to investment demand, jewelry, and silverware. This dual nature creates interesting dynamics. When economies grow, industrial demand increases. When financial uncertainty rises, investment demand increases. Silver can respond to both growth scenarios and crisis scenarios. This characteristic makes silver behavior somewhat unpredictable in the short term, but it also provides multiple fundamental drivers that can support long-term value. Consider the supply side of the equation. Primary silver mining has struggled to increase production significantly over the past decade. Most silver actually comes as a byproduct of copper, lead, and zinc mining. When those base metal operations become unprofitable, silver supply contracts, even if silver prices are rising. We're also seeing declining ore grades at existing mines. It takes more energy, more processing, and more capital to extract the same amount of silver compared to 20 or 30 years ago. Meanwhile, industrial demand continues to grow. The renewable energy transition requires silver. The electronics revolution requires silver. These aren't temporary trends. They represent structural changes in how our civilization functions. Does this guarantee higher prices? No. But it does create a fundamental backdrop that serious investors should understand. Why 500 ounces specifically? Let's be clear, there's nothing magical about this number. You won't find it written in ancient texts or encoded in market algorithms. But it represents a meaningful threshold for several practical reasons. First, it demonstrates commitment beyond casual interest. Someone who has accumulated 500 ounces of physical silver has made a deliberate decision. They've allocated capital. They've arranged storage. They've thought through the logistics of owning real assets outside the traditional financial system. Second, it represents substantial purchasing power, even at modest silver valuations. At current prices, 500 ounces represents a material financial position, enough to matter in your overall wealth structure, but not so concentrated that it represents reckless speculation. Third, this level of accumulation forces you to think seriously about security, storage, and long-term strategy. You can't simply forget about 500 ounces in a drawer. It requires intentional planning. But perhaps most importantly, this threshold separates preparation from entertainment. Many people buy a few silver coins out of curiosity. They enjoy the tangible nature of precious metals. They like the historical resonance, but they haven't integrated physical metals into their broader financial strategy. When you reach 500 ounces, you've crossed into different territory. You're hedging real purchasing power. You're creating tangible wealth that exists outside digital systems and counterparty relationships. You're taking your financial sovereignty seriously. Let's discuss how markets actually work, particularly in the precious metals space. Most investors get this backwards. They watch prices rise and feel increasingly confident. They watch prices fall and feel increasingly pessimistic. This emotional pattern guarantees poor results. Professional investors and successful wealth preservers think differently. They understand that attractive entry points often feel uncomfortable. When silver prices have been declining or stagnant for extended periods, that's typically when accumulation makes the most sense. But it's also when popular interest has dried up and conviction feels difficult. Conversely, when silver prices surge and everyone suddenly wants to buy, that's typically when caution becomes appropriate. This isn't market timing in the conventional sense. It's understanding behavioral patterns and positioning yourself to benefit from them rather than being victimized by them. Consider the precious metals cycle from 2008 to 2011. Silver rose from roughly $10 to nearly $50. During that surge, people who had never considered precious metals suddenly wanted exposure. They paid premium prices. They over-leveraged through futures contracts. They convinced themselves that momentum would continue indefinitely. Then came the correction. Silver spent years declining and consolidating. During that period, the very people who bought at the top lost interest. They sold at losses. They concluded that precious metals were over as an asset class. Meanwhile, disciplined accumulators spent those years building positions at much more favorable prices. What's the lesson here? The market rewards patience and punishes impulsiveness. It rewards discipline and punishes emotion. It rewards preparation and punishes reaction. If you're considering building a position toward 500 ounces, or if you're already there, you need to internalize these psychological realities. Your emotions will lie to you. Your instincts will mislead you. Your discipline must override both. History doesn't repeat, but it often rhymes. Let's examine previous periods when silver played a significant role in wealth preservation and portfolio protection. In the 1970s, the United States experienced persistent inflation following the end of the Bretton Woods system. The dollar lost its gold backing. Confidence in paper currencies declined. Precious metals surged as investors sought alternatives to rapidly devaluing cash. Silver rose from roughly $2 per ounce in the early 1970s to over $50 by January 1980. That represents a 25-fold increase in less than a decade. Now, before you get excited about similar gains, understand the context. That peak was partly driven by the Hunt brothers attempting to corner the silver market. When their scheme collapsed, silver crashed. Many late investors suffered severe losses. The lesson isn't silver can go up 25x. The lesson is that during periods of monetary instability and currency devaluation, physical assets gain importance, and that manias create temporary dislocations that ultimately correct. Let's fast forward to 2008-2011, global financial crisis, bank failures, massive central bank intervention, fear about the stability of the financial system itself. Silver again attracted significant investment demand. It rose from roughly $9 in late 2008 to nearly $50 by April 2011. And once again, that late-stage surge created unsustainable conditions. The subsequent correction was painful for those who chased momentum. But here's what's important. In both cases, investors who accumulated during quiet periods and maintained positions through volatility preserved wealth and purchasing power over the full cycle. Those who bought on emotion, whether fear or greed, typically suffered. What does our current environment share with those previous periods? Unprecedented monetary expansion, growing concern about currency devaluation, increasing geopolitical tension, structural changes in the global financial system. We're not predicting silver will repeat previous percentage gains. That would be foolish. Each cycle has unique characteristics. But we are observing similar fundamental pressures that have historically made physical precious metals relevant to diversified portfolios. And let's examine the broader economic context that makes this discussion relevant right now. Global debt levels have reached extraordinary proportions. Combined government, corporate, and household debt across developed economies exceeds 300% of GDP in many cases. This debt burden creates structural constraints on future growth and policy options. Central banks face an impossible dilemma. If they raise interest rates aggressively to combat inflation, they risk triggering debt crises and economic contraction. If they keep rates suppressed, they risk persistent inflation and currency devaluation. There's no clean solution, only trade-offs. This creates an environment where tangible assets with no counterparty risk become increasingly relevant. Silver fits this category. You can hold it physically. It doesn't depend on anyone's promise to pay. It can't be defaulted on or devalued through policy decisions. Consider the trajectory of government spending. In most developed nations, mandatory spending on entitlements, healthcare, and interest on debt continues to grow. Tax revenues haven't kept pace. The gap gets funded through debt issuance and monetary creation. This isn't sustainable indefinitely, but it can persist for years or even decades before reaching critical thresholds. The question isn't if adjustments will occur, but when and in what form.